if you don't have a good handle on your cash flow and your budget, whether you're talking about a recession or whether you're talking about a positive economic time, everything's going to fall apart at some point in time, but it's always further heightened when you're talking about negative downturn, and then you're in a negative cash flow position, and all of a sudden, it snowballs and things can get out of hand pretty quickly.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. Today's a bit of a special episode 150.
Andrew, it's always special when you and I are on the podcast. But yes, you're absolutely right. 150 episodes. And I tell you what, it feels like yesterday when we first started this thing. And it's pretty good. We just get a chance to talk.
Keep hitting another milestone.
Yeah, get a chance to talk and keep hopefully bringing a lot of value to our listeners and our viewers. And it's been a lot of fun. And can't believe we're at 150 already. So there we go.
Yeah, absolutely. Absolutely. So Bills, what are we talking about today?
Well, we're talking to everybody about how do you make your investment portfolio recession proof? So what are the things that you should be considering in terms of your portfolio, in terms of your thinking, because a lot of it is mindset as well too, and some other tips around, say, your personal budget and amount of money that you should have sort of to take advantage of some market movements and bits and pieces, but a wide-ranging discussion around what you should be thinking of what you should be thinking of for your portfolio during a market downturn.
Yeah, absolutely. Absolutely. So how do you make yourself recession-proof, Bills?
Well, Andrew, I think the place to start is probably let's just cover off on what is a recession.
Yeah. So look, I guess a recession is generally categorized as something where it's a significant economic downturn. So usually you're categorizing it as a recession when you've got two periods of negative growth is ultimately what it is. So you've got two consecutive periods of negative growth when you're talking about GDP. Now, for a lot of people, that might make a little bit of sense.
Too early for the acronyms.
Yeah, exactly right. So what you're talking about is an economy going downwards in two consecutive quarters is ultimately what it boils down to.
Yeah. So essentially, it's not experiencing growth. It's rather than growing, it's contracting.
Exactly right. Exactly right. Now, that doesn't necessarily mean that there's calamity, right? So a recession sounds like, things are horrible, like, you're talking about, the Great Recession. But in reality, I mean, you could have two periods of, negative 0.1%. Yeah. That's technically a recession, but it doesn't mean that there's been a huge downturn in markets, although generally when you're talking about a recession, you're talking about a significant downturn, maybe 10, 15, 20%.
Yeah, and probably just on that note as well too, I mean, we've been accustomed to not just in our economy, but in terms of our own personal budgets and just in life, that the expectation is that we continue to grow.
Yeah.
So, the economy continues to grow, your income continues to grow. This is just looking at it from an economic perspective, basically saying that the economy did not grow for those 2 quarters in a row.
Yeah.
And it went backwards.
Yeah, exactly right. Yeah. Exactly right. So what do you do?
What do you do? I mean, there's a lot to cover. I think the first thing, look, over the top of all of this is keeping a level head, and depending on the position that you're in, you can maximize your wealth creation journey. So hopefully that comes through in terms of the different bits and pieces. I think the first thing is making sure from a personal cash flow and budget perspective, you've got that locked away and you're confident in terms of where your money goes. Because if you're experiencing issues, I think, in your own personal budget with your cash flow, and let's give an example where maybe your expenses are higher than your income, when you see the news come through, when you hear about the data, it's just going to increase your level of anxiety, and you're going to start to think around, oh, geez, my investments are going down, my assets are going down, and you're probably going to make rash decisions. And we'll talk about timing of selling assets and bits and pieces and the psychology around that. But you're probably going to make the wrong decision at the wrong point in time because your house is not in order. So I think it's really critical to make sure that your personal position around your money flow is locked down, which is, if anybody's listened to the podcast and stuff before, we always talk about our cash flow system and making sure that we've got discipline around our money management, because that is literally the key for basically everything. That's the key for the front door. Yeah, exactly right. If you don't have a good handle on your cash flow and your budget, whether you're talking about a recession or whether you're talking about a positive economic time, everything's going to fall apart at some point in time, but it's always further heightened when you're talking about negative downturn, and then you're in a negative cash flow position, and all of a sudden, it snowballs and things can get out of hand pretty quickly. So that's definitely the first point in call. Yeah. Next.
And I think the next one is having emergency accounts. Yeah. And this is, again, another one of those things that irrespective of market cycles, you need to have emergency funds. You need to have contingencies in place so that if something were to happen and if you were to, be sick, be injured, be off work because you've been made redundant, whatever it is, there has to be an emergency fund there to be able to pay for expenses and to cover your living expenses for a period of time. Normally, we like to talk about at least 6 months worth of expenses. Mm-hmm. So, if something happens, you've got 6 months worth of expenses covered so that you can essentially sort whatever you need out, depending on how conservative you are, depending on whether you've got kids, whether you've got a mortgage, whether you've got, all of the other people that are also dependent on you. You might want to push that out to 12 months worth of expenses. But realistically, you want to have at least, some people talk about 3 months, but I think that 6 months gives you enough time frame to be able to sort things out. 6 months worth of expenses in liquid savings that you can draw down on at any point in time if you were to need anything. Because when you're talking about a recession, you're generally talking about potential redundancies, you're generally talking about companies tightening up. And so if something does happen, you want to make sure that you've got that covered for a period of time. Yeah, and probably just two things to note on that, Andrew. I think the first thing for people listening and going, oh, geez, Andrew's talking 3 months, he's talking 6 months, he also mentioned 12. One of the things that I think is, and it's hard in an economic downturn because you may not necessarily know, but security of employment. So if you are in a position where your employment is really secure, you've been there for a long period of time, you've got accumulated annual leave, you're entitled to long service leave, maybe you'd feel comfortable taking that emergency fund and making it smaller or shorter simply because you've got more resources with work and a greater security of income. Whereas if you're in a position, maybe you've started with a new employer, you haven't met probation, it's one of those industries that's heavily impacted during just recession, business, consumer confidence, all of that sort of stuff. Maybe you'd push it the other way. And I think the best way to articulate what you're trying to achieve with that is not necessarily the monetary value itself, but looking at it from a time frame perspective and going, okay, if I lost my income, if I lost my job, what period of time would I feel comfortable with having that safety net to then turn around and say, okay, yep, we're comfortable. We know that we're good for 6 months. So I've got X amount of months in order to, find another job or whatever it may be. So convert that to income, and that time frame is different for everybody, taking all of those variable factors in place. But realistically, you're absolutely right. Having that there is key, because if that's not the case and you don't have income coming in, it's only a matter of time before, you need to start taking some drastic action to try and reverse that. So I think there's some pretty good things. Andrew, what else have we got next up on the list? I think keeping a level head and not panicking is the biggest thing. Panic selling is a really big thing when you're talking about an investment downturn. So usually what you see is investment markets, start going down, and you see everyone flock to sell their assets because they don't want to be, caught at the very bottom or selling at the very bottom. And so you generally see another snowball effect of investors selling at a point in time, which is generally the worst point in time to sell. Yeah. The investment philosophy, to quote your main man, Warren Buffett, the investment philosophy that you want to adopt is buy when people are selling and sell when people are buying. Now, that sounds fantastic in theory, but in reality, it doesn't feel comfortable to be buying assets when assets are going down, but that's exactly what you should be doing, which we'll touch on a little bit later on. But I think the most important thing is not selling.
Yeah. Yep. No, 100%. Absolutely. If you think back to your original intent, your original investment strategy around what the idea is of investing in a portfolio or markets or whatever it may be, generally speaking, for most of the clients that we're talking to, it's a longer term investment. Yeah. So tying into your don't panic sell, if you go back to your original investment philosophy and theory and framework, you force yourself into a decision because of what's happening in the market, which is then removed from your investment strategy that you've put together, at least originally. So coming sort of full circle, you need to keep your original goal front of mind when this stuff happens, because if you look back at the history of markets, they're volatile. It's just the way that it is. So what we've experienced before, we will experience again, no doubt. But going into it, you should expect that your investments are going to drop at some particular point in time. Now, if that doesn't line up with the timing of that, if that doesn't line up with your investment goal and your strategy, then panic selling is definitely not the way to do it. You're almost better off just turning off the news.
Yeah.
With a really big caveat here that I'm going to stipulate in a sec, but turning off the news, turn down the noise and just stay focused on your strategy, with the assumption that you've got really good quality assets that sit within your portfolio. We'll talk about that in a sec, but turn off the news. It helps you keep a level head. It's the best thing that you can possibly do.
Absolutely. Absolutely. Now, I know it's cliched and I know that it's not 100% correct, but you don't lose money until you sell the asset.
Yeah.
So provided that, you've still got money coming in, provided that you're still doing exactly what you should be doing from a strategy perspective, which was the original, plan.
Yep.
As long as you're holding good quality assets, which Billy's already touched on, and you're not buying trends, you're not buying, your assets that are incredibly volatile. You're not talking about penny stocks that could potentially go to zero. Yep. You're buying good quality assets that are going to be around irrespective of market conditions, and the expectation is they're going to increase in value over the long term. Well, then what it does today, tomorrow, next month doesn't really matter. And the example that I like to use is consider your family home. If you sold your family home today, you would get a very different price to if you sold it tomorrow or next month or in 3 months or in 6 months. Most people don't really consider the value of your family home when you're, talking about your overall net wealth on a daily basis. Mm-hmm. They're not tracking and following the daily price, but it's going to be volatile just like any other investment. Yep. But when you look at it now, and then you go through a recession, and then you go through market cycles, and you look at it again in 5 years' time, generally speaking, it's worth more. In 10 years' time, even more, 15, 20, 30, and so on and so forth. So provided that you've got that long-term time frame, provided that you're buying a good quality asset, turning off the noise and making sure that you're not making an irrational decision is the best thing that you can be doing.
Yep. The other thing too, just on that note, if you've got good quality assets and you haven't bought based on a trend or a tip or anything like that, so you've got a robust portfolio, a lot of the portfolio construction that we put together has multiple elements of growth. So you're talking about the capital growth. So potentially let's talk about a share. So the share price going up and down in value. That underlying business, even if we are experiencing a recession, is probably still making profit. Yeah. So they're distributing income to the shareholders. So in that instance, you've still got a return on your investment in the form of income. It's just not necessarily represented by the capital because maybe the future outlook is lower because, the economic environment has slowed down or what have you. But coming back to the high quality assets, I don't think that can be understated.
And provided that you're in a, diversified portfolio, which for most people, you probably should be. Yeah. your property assets should still be delivering an income. They should still be getting a rental income off the back of it.
Yeah.
Your infrastructure assets should still be delivering an income. Your bonds, your term deposits, your fixed income should also still be delivering income into the portfolio. So even though you might be seeing valuation decreases, what should also be seeing is income coming into the portfolio to help support buying more units.
Yep.
And so, which is one of the other things that you might also want to consider is having money aside to take advantage of these opportunities.
Yeah. So going back to the great man Warren Buffett around be greedy when others are fearful and fearful when others are greedy, and this takes a fair bit of gumption, and it's against the psychology of what your brain tells you to do, but basically buying into a downward market is probably the best thing that you could possibly do, assuming that you've got those boxes ticked that we were talking about before in terms of, liquidity funds, emergency funds, security of income, so on and so forth.
Don't drive your emergency fund to zero to buy into the market in a downturn. That's not the right strategy.
So
but
it takes a bit to do. But realistically, and we'll talk about timing the market and stuff in a sec, but realistically, I think if you tick those boxes, that's the best thing that you could possibly do, especially if you've got a really robust portfolio that's made up of high quality assets. If that's the case, those businesses will not be going anywhere.
Yeah.
So if you view it like, and I'll give you a perfect example, but if you view it like you're buying them at a discount, then, you're buying them at a discount. You try and load up as much as you possibly can. Let me give an example that I think resonates really well. So let's just say the suburb that you live in, the average house price is $1 million. And tomorrow it drops to, I don't know, 700,000, so 30% discount. If you had the money, your thinking will probably be, oh, geez, I'm going to buy up as many houses as I can because they're trading at a discount.
Yeah.
It's the same thing with the market, but when we apply it to a different asset class, maybe not particularly property, we tend to think about it a different way. And rather than leaning into that opportunity, we tend to run away from it and perceive it as a threat.
And that's why I think that, property can be such a valuable asset class, because it takes so much to buy into it. It takes so much to sell out of it that it's not that you can't, but it's incredibly difficult to make a decision to just sell and that's it. Yep. Whereas when you're talking about, shares or managed funds or ETFs or whatever it is, it's generally the click of a button.
Yep.
Like it's as quick as that to, make a rash decision. And so, you think about the amount of time that you have in a day, and it just takes 1 second of you to think, nah, it's not worth it, and click that button and it's done. So really, one of the considerations, and some clients love to just have money aside for exactly those opportunities. So have money set aside in liquid cash for at some point in time there's going to be a market downturn, just to be able to buy into the market then. Now, the reason I like that is not because it's the most opportune way to invest. You can take all the think work out of it and just dollar cost average, which essentially is a fancy term for put money in on a regular basis. Irrespective of whether markets are good, whether markets are bad, you put money in on a regular basis, and it takes all of the think work out of it. It averages out your buy price. And so you're always investing irrespective, which I think that is probably the best approach, because you don't need to wait on the sidelines and miss out on growth. But the reason I like to have, or some people like to have money on the side, or the benefit of having money on the side to buy in when there's a market downturn, is it actually flips your psychology. So rather than having the psychology of, hey, markets are going down, I need to keep investing, I need to keep putting money in.
You're waiting for it.
It's, hey, this is what we've been waiting for. So that simple thing, and even if it's, doesn't represent a huge amount of money, and it's only a small amount of money, but, you're then changing your psychology of, great, this is perfect, this is what I've waited for, and on you go. That can be another way to kind of just flip your psychology a little bit around recessions and market downturns.
You focus on the positive being on buying stuff cheaper, as opposed to focusing on the negative going, my portfolio is decreasing.
Exactly.
On that note, not trying to time the market. So all of those things that you were talking about, basically talking about timing the market, or not timing the market in particular. And this is where, you look at a chart and you've got this data and go, yeah, there's no way known I wouldn't have not sold as I started to see it come down, and I wouldn't have not bought at this particular point in time. But realistically, it's impossible to time the market, which is why you were talking about dollar cost averaging. Just going back to your thing about having excess funds, one of the things in my experience with investing over the years is you can never really pick it.
Unless you're a billionaire. Maybe if you...
Or you've got insider information.
Yeah, exactly right. But I mean, if you could pick it, you'd be a billionaire. Like there's no way knowing that you can consistently time the market.
But the only thing in my experience is recognizing when, and I'll give an example, but recognizing when things do turn and it represents a buying opportunity.
Yeah.
That's probably the only time, and you don't know how far it's going to before it finds support at the bottom and starts to kick up again. But that's the only time in my experience where I've looked at it and gone, okay, this is a time to be able to do it. So as an example, during COVID, when we did see the market turn down very, very rapidly, and as it turned out, it kicked pretty quickly as well too. But during that period of time, that was a buy indicator. And, we were on the phone to clients that we knew had excess funds in cash waiting for the opportunity, basically saying, now is the time, away you go.
Yeah, exactly right. Exactly right. So if you're timing the market, which is essentially what you're talking about, it should represent a small part of your overall strategy. The last thing that you'd want to do, and the reason that I say that is, let's say that markets, are going up, and I'm going to keep it quite simple, so I'm not going to talk about compound interest or anything like that. But let's say markets are going up by 10% a year in a particular asset class. You sit on the sidelines, you wait for 3 years until there's a market downturn, and it's great, there's a buying opportunity and I'm buying assets at a cheaper price. Well, the market's gone up 10, 20, 30% by the time that you're buying in. And sure, maybe there's a 30% decline, but that's just where you could have gotten into if you invested at the very beginning. And if it, only goes down by 10% or 20%, well, then you actually would have been better off investing initially. So have an element of regular contributions, have an element of your long-term strategy, have, cash flow buffers, or have emergency funds and cash flow buffers that are also set aside to cover all of the other expenses. And maybe you might want to have a small amount of money to be able to take advantage of either market downturns or opportunities to invest that, a particular stock has gone down in value. You don't need to wait for a recession for everything to drop. It's, hey, I know that this is a really good business, or I know that this is a really good asset.
Yeah.
And okay, I'm going to, have some money aside so that, okay, if the valuations go down because there was some negative news and the market's reacting to that, great, it's a perfect buying opportunity. So having funds available for buying opportunities is another way to be able to, time a smaller aspect rather than your entire strategy based off that.
Andrew, well said. I've probably got 2 closing dot points around that. Don't overcommit.
Absolutely.
And then get advice, because the advice piece will help bring, I guess, the one step removed from being caught up in that psychology. And that's the reason why us as financial advisors have an external financial advisor to be able to pulse check those decisions, so we're not making those decisions based on pure emotion, because that's when you make mistakes.
Absolutely. I dare say that probably some of the most valuable advice that we've given hasn't been, hey, invest in this and it's going to, make you rich. It's okay. Just take a step back, hold tight. And, once you go through it and you, experience that once, twice, 3 times, it just becomes, part of the game. So, I couldn't stress that more, because your advisor should be bringing you back to, hey, it's a long-term strategy. Yeah. This is why we started. And so not making an irrational decision is key.
And it's expected.
Absolutely.
We experience volatility. That's just the way that it is. So, Andrew, I think that's a wrap for episode 150. Thank you for today.
Thank you very much, Bills, and thanks for the other 149 episodes as well. It's always been a pleasure bringing value to our viewers and our listeners, and thanks to all of our listeners and subscribers. We really appreciate it.
Like and subscribe, and we look forward to catching you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.